Lane, you're very welcome to another episode of Kickoff Sessions. Really appreciate you hopping on and a short notice as well onto the episode for today. I think with the background you have in property is going to be hugely valuable to people my age because property is something that's not really considered until you're 30. You have no hair, you are trying to settle down, and people are thinking of it incorrectly, I think, a lot of times. So it was great to see a lot of the work you've done on it, and I'm excited for this.
Yeah, thanks for having me. Aloha, everybody.
Yeah, super excited for it. So if you want to give a bit of a background beforehand as to how you got into this really from the ground up and where you've kind of got to at the moment.
Yeah, so currently I kind of run a syndication business where we put together large apartment complexes as investments for a small group of investors. Currently own over 5,000 rental units. But it didn't always start off that way. I started to invest back in 2009 as I was still working my engineering job. Up until that point, always taught to go to school, study hard, get an engineering degree, and then all that bad financial advice that everybody tells you to do that to me isn't really make any sense. Like buy a house to live in, invest in your retirement funds, work at your job for 40, 50 years. That's if you want to do it the slow way, um, you can do that. But there's a different way that I kind of discovered by buying my first rental property back in '09.
Mm. How did you get into that? So like when you started building a portfolio, let's go ground zero. Obviously 2009, you may have been working a job, you may not have been, essentially making a lot of cash at the time. Whereas for people that are my age as well, who are, in their early to mid 20s, could be quite similar. So what was your kind of step from the very beginning to get going?
Yeah, I mean, I was in my early 20s at the time. I had a good paying job. And then, the type of a real estate investor we're going to talk about today is more passive type. I think most times when you think of real estate investing, you see what's all on those house flipping shows. We're not going to talk about any of that type of stuff, right? That stuff is active jobs. It's high risk. It's exciting though, but the type of investor I'm going to talk about is just buying for cash flow, and you're going to need 20% down payment. So back in 2009, I had a good paying engineering job, where I was able to save, pretty quickly for down payments on properties. So that's what I sought out to do, was buy a house to live in.
Mm.
Again, I don't really necessarily agree that that's good financial advice, but that's how I started out with. But I quickly turned that property that I lived in and turned it into a rental property because, as most young people working out there, they put you out on the road. I was never home, so it was kind of silly for me to have this big property all by myself. And then, started to rent it out, and that's where I got this taste of cash flow. And I realized, wow, if I just kind of rinse, wash, repeat, do this a handful of my times, I'll be able to, quit the rat race, fire my boss, and do what I want.
Mm, yeah, and that's really cool because like that's very applicable under Irish rule as well as the US because since 2007, the crash that came in 2007, you need 10% at a minimum, and 20% even seems quite high to be honest. So to see that you've got the 20% and then we're able to get into your own first property because that's a very good entry point, even for myself. If I was to get into getting that property that is affordable at 20% and then be able to maybe even leverage that and move up to another property from there. That's kind of the approach I kind of want to go to, even though you still need 10% or 20% on the second property in Ireland. But again, you essentially have another income stream that you can rent out and then leverage it back offer. So what's the approach for the first one? So you picked your house or whatever, was it medium value? How did you kind of afford it? What was sort of with like the mortgage and trying to repurpose it then to scale up from there?
Yeah, I mean, the first couple properties I bought were really stupid. They didn't make any financial sense at all.
Mm,
But even if they weren't that great of rentals, exactly to your point, right? They help you buy the next property. They put money into your pocket. And the key difference between you owning your own house is you're the sucker paying the mortgage, right? Putting your heart, sweat,
mm,
and tears in that stuff. Where when you own a rental, your tenants pay that for you, and you're getting the equity build up there. So, and that's the key differential between buying your own house and buying rental properties. So,
mm,
the big thing is just buying properties that make sense. So today, when we kind of help people get started, and the first one is always the hardest, target places that aren't in the sexy areas. Here in America, like Boston, New York, California, Seattle, Hawaii, they don't make sense. we have to go to more of these secondary markets where I think a lot of you guys haven't heard of. I mean, heck, other than Dublin, I don't know anywhere else in Ireland, I'll be honest, right? Like, B-side or lowlands. I mean, I think that's just like whiskey regions, right? That's not right locations. That's all I know. But you probably know where these places are, right? These are the less sexy areas, more secondary and tertiary markets is what we call. The reason why we go there is, we look for this thing called the rent to value ratio being 1% or higher. So you take the monthly rent divided by the purchase price. And for us, it needs to be 1% or higher. So, like take a place like California, right? And I'm assuming Dublin is a good place to live. That's probably a primary market. In California, you're buying a place in the dump for 400 grand that rents for $2,000 a month. So 2,000 divided by 400 grand, that's 0.5%. That's not going to work. We need 1% or higher to be able to cash flow on a monthly basis.
That's so interesting, because if you look at it, Dublin in specific, Dublin is one of the highest rental and actual cost of a house in globally at the moment. So it's up there with California, it's up there with Paris, Hong Kong, which is crazy because it's just demand and supply in terms of the availability of houses. We don't actually have that amount of supply for the demand that's there. So that actual trade-off makes a lot of sense at 1%, because it's not really achievable in these real booming areas. And actually, I have an interesting theory for you. There's a theory called Keynes' beauty theory, which you may have heard of previously. It's a common investing actually like strategy. It's so if you had a beauty contest of 100 people, people are always looking at number 1, 2, and 3. It's like the most beautiful girl, the most beautiful guy, which is your prime locations of rentals in this instance. But it's really the middle area of the people that are 20 to 40 that has the most potential, because no one's investing in them, no one's putting the time into them. And as a result of that concept, a lot of these places actually have more potential to grow. So if you take that principle again and you look at places like, I don't know, Oregon, Wisconsin, North Dakota, these positions are where you could get maybe higher than 1%, maybe 2%. And that's where a smart money is actually going, oddly enough.
I like that, man. I'm going to start using a Keynesian beauty contest. I mean,
Yeah.
so the way I've explained it, which kind of supports your theory, is it's like where the dumb money is, where you don't want to be. I mean, the dumb money is in California, Seattle, all these high price areas where there's just people with too much damn money. And there's always, and we'll kind of talk about this a little bit, right? But you need to get outside your comfort zone and go to these less traveled places. And more than likely, these places to buy rental properties is not going to be in your backyard. I mean, I live here in Hawaii. I'm not going to buy in Hawaii. There's just like the prices are just stupid. We have too much dumb money, international money, right? A bunch of Chinese just laundering money here. Just don't even make any sense, right? Like, why would I want to compete with stupid money? I need to go to that second, third rung of areas that just has a little bit less heat on it.
Yeah, makes a lot of sense. When you started from there, so especially looking at rent to value ratio, which is really, really interesting. And you made probably a couple of intelligent investments at first, and then maybe not so intelligent at times. How were you able to kind of scale that up? Because people always look for things that are more scalable, but often the more you bring on, the more workload and the more difficulties that come with this, So what was really your approach towards something like that?
Yeah, I mean, like the part of the reason why we go after properties at cash flow is we have the revenue to support a third party property manager. So we're not doing this stuff by our own. Most of my clients, they make good salaries. They just want to invest passively with us. So this person, the property manager, is key when they're first rental properties. Usually, the property manager takes maybe 10% of the rents, but they're well worth it. I mean, I don't know how to do an eviction person. I'm sure I've done dozens of them in my past, but I don't know how to do it personally. Like, I don't know how to fix a toilet, right? Like, that's not my job. My job, like, I tell people, don't be a landlord and be an investor.
Yeah, that's really difficult. But that's the difficulty in the beginning when people are way too committed. It's in their back garden, and they don't have a hands-off approach. It's really hands-on, which I think you may need to do at the beginning. Would you agree? And then you have to maybe go to a step where you take a step back then after a while.
Yeah, it's usually one or two things, right? And I think in the beginning you got to do it because you don't have that much money, and you might have to bridge the gap with a little bit of sweat equity. But secondly, I think after that first beginning point, it's usually just ego, right? People feel like they can do a better job than most people, which is not the freaking point. The point is the scale and grow your net worth. At the end of the day, if you're an ego person, net worth is all that really matters.
Mhm. So going into maybe some of the detail on actually the properties themselves. So what would you advise in terms of like rooms, capacity? Like, should you be looking for something like a one bedroom to get going, or should it really be something that you think has like a higher return? Like, how do you essentially value these different elements?
Yeah, I mean, when you're buying single family homes, you want to just kind of go stay in the middle, right? The median. The median is typically here in America, like a 3 bedroom, 2 bath, for a family of four. Typically, it's going to be 1,500 to 2,500 square feet.
Mhm.
Um, that's kind of like the commodity, the bread and butter. We kind of go after this sector called workforce housing.
Mhm.
So here in America, that rents from anywhere from $700 to $1,500 a month. Um, I don't know how it is where you're at, but here in America, we have some rich people, but most of us are lower middle class, right? And that's the kind
Mhm.
of the population we want to fill. So we don't buy luxury properties because the rent to value ratios there don't make sense either way. And we want to be able to, be in this area where we kind of catch people if there's a recession coming back to our value based
Mm.
apartments or houses.
That's interesting. So essentially, in like a recessionary period or a period whereby a location devalues, do you think that protects you at a higher rate? So if you were to go into something that has 2 to 3% rent to value ratio, and then during a recession it decreased, does that give you that protection and exposure versus somewhere that you're just making 1% marginally?
Yeah, I mean, it come at that point you break it down on like if your rents are $1,000 a month, you should be in tough times. You lower the rents a little bit to 800, $900. You still protect the asset. You still make your mortgage payments,
Mm.
and you still hold on to the asset. And at some point after the big shuffle kind of happens, you have more tenants kind of coming back, and they need your housing, right? They need value based housing. So I
Mhm.
mean, it's kind of like in good times it does well, in bad times it does well. That's what you want, right? You want to invest in boring things like that.
Mhm. So you've obviously been doing this for like years and you've seen the different trends. Do you think like things like Airbnb, for instance, are better opportunities for rental properties? Like, would you advise maybe looking at something like this? Or is it really looking for longer term tenants where you see actually more value?
I mean, you can specialize in the niches, but I mean, the way I invest, like I said, is just strictly going to long-term workforce housing, real
Yeah.
boring bread and butter. Very common niches are like your short-term rentals, like you said. I don't like it because it's a very discretionary item. It's when people travel for fun. It
Mhm.
just gets blown out of the water when a pandemic happens, right? Another
100%.
one is investing near college towns. I mean, if the college builds a dorm, you're screwed. Uh,
Mm.
Building in military towns, that's another thing. Military changes how they do things. I just like investing where you have regular blue collared folks, where they have stable and robust job
Mm.
environments in the area.
Yeah, because that's a big thing, especially in Ireland, around, you pick a location and then the location turns into like a lot of crime, or there's a lot of issues there because they're essentially like building like high-rise flats or something like this. So is there anything else what you just outlined in terms of like, okay, education, which is interesting because people always say buy college accommodation, so that's an interesting take on that. Military, is there anything else that you'd always also like stay away from, or you would advise, like if it's a commuter town, which there's loads of them in Ireland because we can't build up, or we can build up but not that high. um so would you advise something like that, or is there any other areas that come to mind?
Yeah, I mean, we never really buy in the city center, in the core areas, because it's just too expensive. We're usually about like a 30-minute to hour commute outside the city center, right? And
Mhm.
typically you can kind of buy more garden style apartments in that area, or these are kind of considered the suburbs. So those are kind of the places that we like to target. And look, you got to know your clientele. And I think that, the type of clientele we go after, this value driven workforce style housing that caters to the regular people working regular jobs, is one of the biggest, potential tenant sources that you can get out there.
Mm-hmm. Mm-hmm. So if we're going to go backwards in terms of the actual individual, so in terms of maybe like cornering off your own cash or managing your own funds to be able to do this, what's your kind of strategy? Because I know when people like take out a mortgage and they do just some sort of buy to let, let's use an arbitrary figure of the mortgage is $1,000, they're making $1,500, and then there's 500 here of a surplus. How should that be managed in terms of scalability? And also, how should that be managed in terms of covering the costs of your managing property, and any other things you need to do along the way?
Yeah, I mean, the property should support itself and then some, right? That's why you're buying a property that cash flows. People want to dig more into the numbers, they can download my free analyzer on my website, simplepassivecashflow.com/analyzer. Kind of dig into the numbers, but go back to your question, like, what do you do with the surplus, your monthly cash flow? After you've assumed for big repairs to happen here and there, just kind of sock it away. But that free cash flow definitely shouldn't be going to paying down properties. Sophisticated investors don't do that. They hold on to the debt as long as possible, and they use the free cash flow for more down payments, for more free properties. Right? Just keep it growing bigger and bigger and bigger.
Yeah, I get you. And then so that process will essentially go on for, you can just rinse and repeat it. But if you're going from property one to property two, you use that free cash flow to essentially build up another deposit, and that deposit then can be used. Is that your approach?
Right. Because there's two ways of doing this, right? You use property 1 and 2 to pay out property 1. Well,
Mm.
then in 30 years, we'll have 2 properties. Whoop-de-doo, right? But what you want to be doing is using property 1 to go property 3, and then 1, 2, and 3 to buy property 4. And keep growing that and grow it and grow it and grow it.
Mm. And at all times, it's managed by a different manager. So it doesn't matter how much properties you have. You just have someone that's going to be in there actually doing like the maintenance, the repairs, because they're going to be an agency.
That's correct. That's correct.
Mm. That's a very interesting concept, because if you compare that to the traditional route of people saying just get one, have a summer house or whatever. But I think really when you're able to calculate that actual, rent to value ratio and scale it from there, that's where the actual value comes from all this.
Yeah, and that's what kind of frustrates me, right? Like, there's so much bad financial advice from people who aren't financially free themselves, right?
Yeah.
Parents, coworkers, like, the heck do they know, right?
Yeah.
Like, I mean, maybe what they did worked, but look, I blew them out of the water. I kind of, I follow what the math does, right? Do the numbers yourself. The numbers will tell you what to do. Other than that, it's just a bunch of game theory and, thoughts of what's the best, right? But when you follow the numbers and you kind of work off a cash flow rubric, like, I mean, the optimal solution kind of presents itself, and that's just kind of what I'm presenting here.
Mm-hmm. So, and especially in terms of like just essentially generating wealth at any level. So if you have all this and you have a lot of different concepts around how your wealth should be dispersed in different investment strategies, even your 401k, which is your pension in Ireland, how do you essentially like approach things like that, especially the 401k? Because in Ireland or everywhere, they always say to maximize that value, because companies will often meet you to a certain percentage. So I'll give you some basic figures. Large companies will match you up to 5% generally. So they would encourage you to put 5% in, and then everything after then is up to yourself. And the argument to that as well is that you should be putting in additionally, what even is it? I think it's half the
Yeah,
years.
well,
You
you know
half
what?
the
All that stuff
years.
is nonsense, right? Like,
Mm.
I'm your rich uncle, and I'm telling to you straight here, right? Like, wealthy people don't use those retirement accounts, because here's the problem: when you're in those retirement accounts, you're kind of captive to a bunch of garbage investments, right? Like
Mhm.
certain brokerages that they want you to do that stuff so they can just rape you with all these hidden fees that you don't see, right? That's
Mhm.
why, like, when I wanted to rent a property, I mean, go look at my website, simplepassivecashflow.com/returns. I break down all the math. With a crappy rental, I'm making like 20 to 30% returns on my money. And I look, when I'm in my 20s, I'm like, well, why am I putting my money in this 8 to 10% stuff that goes up and down like a roller coaster? The, the decision is right in the numbers.
Yeah.
Why would I want to do that stuff if I can just do it myself and make way, way more and safely and more tax advantage ways? I don't do retirement accounts because like I want to pay my taxes today than in the future. The government wants you to put your money in this stuff so they can tax you where the heck they want in the future. They essentially have a big lien on all your retirement funds. So you're playing exactly into their scheme. What you want to be doing is you're paying your taxes today, getting out of that damn stuff today while your taxes are lower because you don't make as much money in the future, right? But they have it all wrong. They kind of trick you into thinking, oh, in the future you won't have a job, therefore you're being a lower tax bracket. Well, maybe that's true for most people, right? But for me and you, that's kind of upward trajectory. I would think you have more investments in the future and you're going to be baller in the future than you are today.
Yeah,
Be a much higher tax bracket.
You're gonna have at least have more like investment options to you, and hopefully more incomes at that stage, like different income streams.
Right.
So
More
you're gonna want to
assets. It's
utilize.
just time's going to happen. So pay your taxes now and get it out of that stupid thing
Mm-hmm.
and not do it. But, it's just an example of, just bad financial advice. The system is engineered, obviously, to get you to invest in that stuff, right? Because if everybody said what I'm going to proposing, just go out and buying a handful of rentals, you'll be able to quit your job in like a decade. It's not a get rich quick thing, but it'll get you out of the rat race a lot quicker than anything else out there that they tell you to do. And then, who most people, and the scary thing is like, well, if people did what I said, there'd be a lot of people that would probably tell their boss to F you and then not do anything, right? Society would crumble. Who would pick up the trash? Who would design buildings? Who would play doctor? Right? You can't have this happen.
You can't have both sides of it, It's interesting what you said about the returns, because like all those pension funds, 401k funds, especially in Ireland, they don't have like 8% return. They're very, very low. There's also the margin in between by the investment fund who take this on, so if you're making, I don't know, like 4% or 3% over the course of 3 years, and they're taking a fee which is compounded, the fee you're paying that's compounded is so high in relative terms, because you're paying this fee over the course of 30 years. So that's also to be one thing to be considering, because it just diminishes your returns.
Exactly. And that's ultimately the people stealing everybody's retirement, right? So somehow they got in cahoots with the government. I don't care what country you're in, but it's a corporatocracy, of course.
One of the main areas I wanted to chat about as well was all around investing and looking at different kind of asset classes in general. So if it is property, as well as just looking at different recession proof or inflation proof and different kind of ways to kind of protect yourself. So, things like returns in general are obviously, they work with you, work against you at the best of times. But I think, especially with inflation, how do you think this is going to affect property, and how should you really kind of prepare for something like this? Because other considerations will be maybe the cost of the materials, so maybe the impact of lumber, the impact of different raw materials have maybe increased the prices, which again will be maybe disadvantages to renting properties and buying properties.
Yeah, inflation's happening. It's happening bigger than you think because the government always wants to downplay numbers, because that's how the government's smart, right? The government goes into debt. They pay for things in today's dollars, but pay it off in the future dollars. So by them going into a lot of debt, most people think that's irresponsible, but that's incredibly smart, and you should be doing that too. So how do you hedge yourself? Well, the right thing to do is to buy hard assets that go up with the pace of inflation. Whereas the tide comes in and floats things. It floats gold, it floats silver, it floats real estate. I like real estate because it makes you money. Gold doesn't make you jack in the process. You can't leverage it either. It doesn't give you good tax advantages either. I think only thing that does that is real estate, which is why I do it. The losers are going to be the people who save their money and pay down their debt. That's the stupidest thing you want to do. And from a litigation standpoint, you don't want to pay off your properties because litigators know exactly how much to sue you for. You can just look it up. You want to encumber yourself of debt. If you have a paid off property, you're a sitting duck.
I get you, because essentially you're just making no returns from it. That goes in well into your actual investing strategy. So you mentioned about income, leverage, and tangible value. So that's essentially having some sort of leverage, having some sort of mortgage, and being able to use this as a means to make additional returns. So I see a lot of people who decide to never pay off their mortgages, to never pay off their um, essentially debt, because they're using it all the time to build additional equity. So how do you approach that kind of area for the last couple of years?
Yeah, I mean, grab as much long-term debt as you can and try and not paying it off. Of course, I mean, I think some people think that's irresponsible. We're not saying like not don't make your minimum payments, of course, right? You got to make
Yeah.
your payments, but like the what you want to be doing is delaying it as much as possible, so you can pay it off in future dollars that are worth less.
Mhm,
And kind of if you can also get the cash flow in the interim in the whole, then it's a beautiful thing. That's what we try and do.
mhm. But it all goes back to risk management anyway. Like, it's all about a risk management framework. So how much exposure can you give, as a person, and what's your risk appetite? So I think once you calculate how much risk do you want to take, how much available funds do you have, from there, then it's fair game. Obviously, you want people that are going to be somewhat taking those risks, whether it's their first or second property, but you need to be able to have that risk reward trade off. Otherwise, you're not going to be able to realize those benefits, or you're going to absolutely screw yourself, and
Right, right.
you're going to take out too much essentially in the process, and then won't be able to repay that debt.
Right. And this is where it comes into play with cash flow, right? How are you doing on a month to month basis, your income minus revenue? Like we're not flipping houses here, right? That's gambling. We're buying properties that on a month to month basis make a positive income, right? So you make your money, you make your income, your tenant pays your rent, and then you subtract all the property management fees, the repairs, big capex, insurance, taxes, and then you also assume that the tenants are not going to be there from time to time too, right? So vacancy, and then you want to have that leftover buffer. So even in tough times, you can even drop the rent, or if a tenant moves out, you can cover it. And that's where you talk about like what we're trying to do here is maximize the amount of leverage or debt, but we're also trying to make sure that we do cash flow a little bit on each property, so we have that safe buffer.
Mhm.
Once you get to that point, let it rip.
Yeah, exactly. Because that's my actual approach towards this, is that like you should be taking these risks and you should be extending yourself, because I don't know, like, as in, if you have available funds, this is the way you should be doing it. How do you factor in though those actual downtimes, like from a even a mathematical perspective? So you mentioned there about tenants, and maybe like tenants are passing over. So let's say they go January to December and you don't get a new tenant till March. Um, how is that kind of factored into the actual equation and baked into the price, so that you are going to be covered in some capacity as you go to leverage up from there?
Yeah, I mean, on your first few properties, you could get unlucky, right? Let's be honest. And that's where I think you want to have maybe $5,000, $10,000 of emergency savings, just kind of in cash reserves in case that stuff happens. But yeah, man, that's why you got to grow the portfolio bigger, right? So after a while, it just becomes kind of a rounding error, and you don't really care. And when you compound cash flowing properties on top of cash flowing properties, your balance sheet gets stronger, and like it kind of smooths out all the rough spots.
Mm, I get you. Is there any situation whereby you're looking to sell property at a later stage? So let's say, for instance, you've accumulated a couple of rental properties and it's going well. There is that like passive income coming through, which is on a monthly basis. In what scenario, if there's a scenario, would you consider selling one of the properties?
Yeah, I mean, you always are looking to move stuff around in your portfolio, right? Like, especially if you are able to, someone's paying a stupid price to you, and then you can go buy two more rentals in its place. Today on our larger projects, we buy apartments and we do a value add strategy where we fix up the property, new flooring, new appliances, new paint job, bump the rents up a little bit to force appreciate the property, not market appreciation, but force appreciation. And a lot of times we may choose to sell the property after the business plan is done in a few years for a higher price, and then exit, and then investors go in different areas and multiple properties, and kind of just keep rolling their cash.
So it kind of grows kind of organically, and you're essentially eyeing up the valuation of the house because you've done that forced increased valuation, then made that decision then to cut that asset. But sorry, this is where I get kind of confused, because if it has increased and you're able to increase the rental return, shouldn't you be keeping that asset instead of letting it go, even though you are going to get a high return for it?
Yeah, I mean, well, figure out how much equity you have in there, and if you can deploy it elsewhere in 2, 3 properties and make more money at the end of the day, then you make the move.
Yeah,
Right?
yeah.
I don't know if you're familiar how like agriculture grows, right? Like coffee, or coffee will sprout out, right? And you got the beans that come off of it. After a while, the stump gets kind of big. You want to prune the tree. It's kind of the same theory. And you kind of want to ride these C curves, and redeploy your funds. Because let's just say you buy a house tomorrow, and eventually 10, 20 years from now, the property is probably going to appreciate, and you're going to pay down your mortgage. So your equity position is going to go up, which is good. But the bad thing is return equity is going down. So yeah, you might be making 20, 30% returns on your money in the first few years, but after 5, 10, 20 years, that stuff goes down to almost single digits. Let's imagine if you owned it outright, which some people think is a good idea. I think is a horrible idea, because you're still making the same amount of income, but you have so much debt equity, lazy deployable equity, that you could be used to buy 7, 8, 10 houses with that. Right? So it's all about flexing your equity so you maximize your return on equity. And this is what separates the men from the boys, right? The amateurs out there, they pay down their properties, and yeah, they might end up with 3 paid off properties by the time they're dead. But I think I'm kind of, proof is in the pudding. What you want to do is smartly re-leverage your money so that you cash flow, right, in case there's any bad times. But you kind of keep prudently roll it into the next asset, to the next asset, to the next asset. Is it a little bit more pain in the ass? Yeah, but
Yeah, if you can just if you can manage that stress of having that cash, and that's the way it is, that cash, that debt, but that's the name of the game. That's actually the way the way it's done. So you have to be able to do it. Is there any
right.
room in your portfolio for other types of asset classes, even if it's land, even if it's actual equities themselves?
Yeah, I mean,
There is REITs.
I do apartments. I like workforce housing apartments, because in residential world, I mean, people need a place to live, and especially in America where we have a growing population, especially lower middle class. I don't see that going away anytime soon. But maybe 20% of my portfolio is diversified in mobile home parks, self-storage, assisted living, different asset classes. But I think at the end of the day, it all kind of caters towards just regular people, right? Boring investing commodities. I mean, I like cash flow, right? Those things cash flow. Land doesn't cash flow. It's gambling, in my opinion. Yeah, I mean, it's just, what are the common necessities that the blue collar people need? And that's what I invest in.
That's so cool, man, because that's like the opposite towards what a lot of people would have told you, would have advised and encouraged you. It's like, what's going to be around today that's going to be around for the next 50, 100 years. My question off that though, is there any considerations for like real hard times? So a long recession period, for people that only have 1 or 2 rentals. Is there any way to protect yourself? Obviously, just free cash flow and trying to have that buffer, or as you mentioned earlier, about 5 to 10%, 5 to 10K in protection. But is there any other things that you can really protect yourself from, so that there's not a situation like 2007 whereby you take out a mortgage and then you wake up and your house is devalued 40%, you're negative equity?
Yeah, well, I mean, the way we do it, we don't care what the property is worth, right? We're buying cash flow streams. Make no mistake, in 2007, the idiots that got hurt were the people gambling on appreciation, not the cash flow people. Cash flow people will beat you. They're fine. They're like, oh, well, at least we're still cash flowing. We're still making money. And then we can go buy the properties of all these idiots who are playing the appreciation game after. So I mean, just look in the pandemic, right? I mean, people need workforce housing, you know, affordable housing.
Mhm.
I mean, I'm not saying that nothing can't happen, which is why I do diversify with a little bit of my portfolio outside of workforce housing sector. But I mean, I think if anything in the world, I mean, it's kind of a commodity, and something I've kind of picked up from very affluent people, like they have the saying like money talks, right? Loud money, right? Instagram money, TikTok money. They're all saying this tech startup or Dogecoin and all these things. But wealth whispers, right? Wealth buys things that are super boring that you're like, like garbage, garbage waste like company, right? Like things
Waste
that are so
management.
basic. Yeah. Like those are often the best investments.
Yeah,
You're
I
not
think
gonna
that's
make
cool.
you're not gonna make your money from 0 to 100x, but you're gonna grow it prudently, and that's what affluent people want. They want capital preservation. I think.
Mhm. I think I'm gonna fuck this up. I think it was Michael Burry that was saying about water like 15 years ago. He was going after the collapse came. I think I could be wrong now on this, but after the collapse came, it could have been like Michael Burry or someone like that. They were asking like, what's next? What's next for your portfolio? Like, what are you looking at next? And he was like, it was like basics. It was like water, waste, the things that are long, boring. But he was like, this is where I
Right.
see like the most growth.
Yeah, no, you're exactly right. He went after that stuff, but the problem there is like we're not Michael Berry, right? We don't have millions of dollars.
Yeah.
What is it that the average dude can go after that is basic necessity? But it's not much, right? You can't go buy 20,000 million heads of cattle, right? Or I don't know how you even buy. I don't know how you buy water. I don't even know,
You buy a
right? The only
dam.
thing, yeah, like I don't know how you would buy that stuff. But the only thing I see in my peripheral is like buying little houses and getting a piece of the rental property world,
Yeah,
right?
at a small
So
stage.
it's like what are things that are accessible to? Yeah.
Mhm. Last question I have around this is what is your experience with getting a rental property with someone else? So, people will often start a company with someone and then the company like collapses because it was their best friend. They realize their best friend can't work, things like this. So what is your experience with like sharing that upfront equity, down payment, which may be 20% or even higher? And would you advise it? What would be your approach for something like this?
Yeah, I mean, we bring in accredited investors to work with us these days, so we're not opposed to it. But if you're just talking about buying your first rental property, I mean, really try and save up the money yourself and do it yourself because it gets messy when you get even a good buddy involved, in my opinion. Save up 20, 30 grand, to buy $100,000 house. It's not that much, right? I mean,
Mm,
maybe if you can only save 5 grand a year, that'll take you a handful of years. It is what it is. But you're going to need to get the loan, and it's going to need to go in one of your guys' names, right? It just
yeah.
gets messy, right? Like, I mean, it's cool having a buddy who's doing it alongside of you and vicariously learn from each other what each other are doing. But I would really, I would really urge people to just get started on their own. And if
Mm,
it takes you a couple more years to save up for a down payment, so be it.
If you eventually went to like start a company that was around real estate with someone, maybe that could be advised. But I think at first, when you're looking to do something yourself, it's kind of a bit of a solo venture, especially to kind of like eye up a market and kind of get that kind of like decision making maybe yourself.
Right, right. When you want milk and cookies, what do? You go buy the milk and cookies. You don't call your buddy over who's got the milk. That's ridiculous. Right? The same thing. I mean, a rental property, yeah, it's kind of expensive when you start out, but if you can't mass up 20, 30 grand, man, you probably shouldn't be in this game. And this is why I like it because
Mhm.
it's not accessible to most people. Not many people can rub 5 grand, 10 grand together to save their life. And that's the
100%.
key.
Mhm.
That's the key.
Like it's done by like loads of education, the beginning of your career, get a decent role or whatever, and then use that as a vehicle. And I've always said that it's about, using your day job, even if you do really love it and really enjoy it, but using it as a vehicle for one, starting your own thing, two, generate another income stream all based off that because you're using money to pay with money. Take podcasting, for instance, you're going to get fuck all money for the first 2 years, but that's not why you're doing it. You're starting off, you're building something which will eventually become actually monetized, but you don't need that because you've been using your day job to essentially fund that essential like side hustle, side job until it becomes profit making.
Right, right. Yeah, I'm a big believer in that too. I mean, you just keep working your day job because it'll make you put food on the table, and maybe you suck at your business. Most people do, right? Let's
Mm,
face it. And if you can't make money while you're still working your day job, then you probably shouldn't make the leap.
yeah. Yeah. Actually, funny enough, I had a conversation with a guy recently. We were discussing that being like, if you do move to start your own thing, there's just so much shit to consider that maybe you're better off working at you a 9 to 5 and then having all this other kind of pockets. So let's say if you're making 100K and 60K is coming from your day job, well, if you had 40K coming from different revenue streams, if it's rental property, if it's several other things, well, you've now increased your net worth by nearly like 60% or whatever. So they're interesting concepts. It's not about going from 0 to 100 and being able to retire. It's a long road, and
Yeah.
it takes many years.
Real estate is something that the average Joe can do. Making a successful business, I mean, I don't know what your thoughts are, but I feel like only like 5 in 100 will be successful.
100%.
For you guys, 100 guys that are listening right now, 25 of you guys are actually going to be legit and do something. The rest of you guys, well, maybe you guys can save some money and be a passive real estate investor.
Mm-hmm. And that's interesting, man, because like the rate of success, people romanticize things often, and there's been a common theme with how you've described stuff, which I've really enjoyed, because people romanticize like a startup, which is fair because like it's cool, it's interesting, and people romanticize, becoming like an MD at a company or a VP at a young age, but really like the real wealth and the real value comes in the stuff that isn't sexy. It isn't super interesting. It's one shitty rental property that's in back ass Oregon that's making $1,400 a month. That if you said to a girl at a bar, she'd walk away from you. But again, you're gonna have more money than the guy that's actually coming out of the
Right.
investment bank. So that's so interesting. It's like often the stuff that it's not talked about is where the actual cash lies.
Yeah. General rule is if you talk to a girl at a first date and it's boring and it doesn't draw too much attention, it's probably good for your financial future.
Yeah, for sure. Get that prenup though, and make sure you don't lose money in the process.
Yeah, yeah. Probably another discussion for another day, how the wealthy do tax and things though. But yeah, I think you guys got the idea.
Yeah, that's the idea. We'll come back to this at a future date and do all the tax side of it and make sure because go through that element because it's funny. Like tax is a whole different world, and I do want to talk to someone about that and try to get real insights into how to optimize your tax, so that you're not being burnt on all fronts. Really.
Right, right. I mean, just quick in a nutshell, I mean, essentially, why do we do real estate? Well, I don't really particularly like buildings or doing all that type of stuff, but I like real estate is the one thing here in America that we can take paper losses for. Right? We have a building and we can depreciate it over such a lifespan and create a negative loss on our taxes. It's probably the only thing out there that can do it. You can't do this with crypto or gold. Right? Only real estate you can have the ability to do this. So also combo that with the being able to aggressively write this stuff off. Now you're opening up a new world of being able to take negative losses on your income, active income side. I mean, people can go to my website. Like I have my tax returns on there. I don't make any money on purpose.
So how does that function? Sorry, because I'm a little bit kind of lost on that. So if you're netting off those losses, how does that operate in terms of tax?
Yeah, so you might make money at your day job, right? But if you're able to have negative losses from the real estate portion, the sum is you make it zero, right?
Yeah.
So you don't make
Yeah.
anything. Therefore, because you made no money, you don't pay taxes.
Oh, I get that.
Right?
That makes a lot of sense.
So
Yeah.
when Donald Trump pays money on taxes, it's probably because somebody messed up and did it zero.
Yeah. All those Trump towers that are hanging around the world that just have his branding on it that are showing
Yeah.
up in Russia.
Yeah. I mean, I don't know. I don't know the character of the guy, but I think he has a lot of good things,
100%.
examples of what to do from business perspective and taxes. It's what all the big shots do out here.
He's a guy that figured it out. As much as if you like him or if you don't like him, it's irrelevant.
Yeah,
He figured out property. He figured out a lot of things that people don't give him credit for. Super wealthy as a result. Obviously, super like successful in what he did as a result. But it's interesting because he's a guy as much as other people who figured out a process early on when they were younger, which is a kind of a lot what you've done, man. Like the stuff that I've heard now, I would have never really heard from people that are pessimistic about real estate and pessimistic about scalability of it. Obviously, you need a lot of cash. Like, there's no doubt about that. However, if you are focused towards it, you can get 20K. If you've built 20K before, you can build 20K again to get another property, is the way I see things.
right, right. I mean, it's a falling forward syndrome, and the first one is the hardest one, but it's not a get rich quick thing, but you can kind of see it compounding over time.
100%. And as well, it's kind of, it's more like aggressive, ambitious goal thinking as well. Like, why are you happy with 80K a year or 100K a year when you could think about things and think about life in a different way, which is I always find really like fascinating, because like if you do think big and if you do want to have a big portfolio and want to do this side for various different reasons, personal, family, whatever, it is possible. But the stuff you've shared today has been all really informative and really helpful.
Yeah, and I think most of my clients, like, they kind of shoot for 10,000 a month,
Mm.
some 20,000 after they figure out it's kind of easy. And then after that, it's just a point of lifestyle um, creation, like designing their lifestyle over that. Maybe they want more, but most guys are pretty content with that
Yeah.
type, and they don't pay taxes with it because it's all passive income anyway. So that
Mhm.
10 grand a month goes pretty far, and that's when your life starts, right? Unfortunately, most people live their life trading time for money on the working side, and they never get over to the other side where they actually have their money working for them.
Yeah. Mhm. And that takes so long. That takes like a psychological shift more than anything. It's like, how are we going to actually shift in terms of thinking about using our cash to actually work for us?
Right, right.
Big
But
time.
the problem, like we said, is there's so much bad financial advice keeping us from making that mind shift change, the game plan
100%.
change.
And that's why you have so much people in that bracket that have not been able to optimize their own wealth over the last couple of years. So, Lane, I'll just say a massive thank you. I really appreciate your time. This was awesome and super helpful towards everyone. So let's say a massive thank you.
Yeah, yeah. Thanks for having me. Appreciate it.